You finally started investing seriously, but someone who started 10 years earlier is already hundreds of thousands of dollars ahead. And they're investing less than you. They didn't work harder, they didn't earn more, they just started earlier. And in a minute, I'm going to show you something that most people miss about this comparison. And it changes how you think about investing completely. Let's make this real. Two people, same strategy, same returns. Only difference, the start date. Investor A starts at 25. Investor B starts at 35. Both invest in simple index funds, steady long-term growth. Income starts around $70,000, grows to about $110,000 over time. Now here's the twist. The early investor puts in $500 a month. The late investor puts in $1,000 a month. Double the effort. So logically, that should catch them up, right? It doesn't. And this is where things start to separate fast. Here's the early investor's path. At age 25, putting in $500, earning about 7% annually. By 35, they've invested around $60,000. Portfolio value? About $85,000. Not impressive yet. And this is where most people lose patience. But stay with it. By 45, now we're looking at roughly $300,000. That's when it starts to feel real. Here's where it shifts. By 55, around $750,000. And by 60, just over $1 million. Same $500 a month. No heroic effort, no perfect timing, just consistency and time. It's like planting trees early. You don't notice much at first. Then one day you get full shade. Now the second path. Starting at 35, investing $1,000 a month, twice the contribution. By 45, they've invested $120,000. Portfolio? Around $165,000. So far, so good. But here's where this changes. By 55, about $520,000. Compare that to the $750,000. That gap just opened to over $200,000. And by 60, roughly $830,000. Still solid, still respectable, but still short of $1 million. Even after putting in double every single month. That's not a small difference. That's years of financial freedom. Now here's the number I really want you to think about. The early investor, total contributions about $210,000. The late investor, closer to $300,000. They put in nearly $90,000 more and still ended up with less. That's the moment most people have to sit with. More effort, more money, worse result. Now, why does this gap exist? At the surface, it's compounding, but that explanation is too simple. What's really happening? The early years, those boring years, are building the base, and the base is everything. The first $100,000, slow, frustrating. The next $500,000, much, much faster. Here's a quick way to think about it. Money grows in layers. If you start earlier, you're stacking layers sooner. If you start later, you're trying to build height without a foundation. That's why catching up feels so hard. Let me be direct for a second. Most people don't fall behind because they choose the wrong investment. They fall behind because they wait. They wait for a higher salary. They wait for things to start feeling stable. They wait until they figure it out. Meanwhile, time is slipping, and time is the one thing you cannot replace later. Another one, trying to make up for lost time with bigger contributions. That's financially harder and mentally exhausting. At 25, $500 feels manageable. At 35, $1,000 to $1,500? That starts competing with your mortgage, your lifestyle, everything. That's real pressure. So what do you actually do with this? If you're under 30 right now, even $400 to $600 a month puts you right on track. Not perfect, just consistent. If you're in your mid 30s, the goal shifts. Now it's about increasing contributions steadily. Maybe you're at 8% in your 401k. Could you push it to 10% this year? That small move alone can close a big part of that gap over time. And here's something simple. Next time you get a raise, don't upgrade your lifestyle first. Increase your investments first. Even 50% of that raise going into investing changes your trajectory fast. Now, remember earlier, I said there's something most people overlook here. It's not just the final number, it's what that number allows you to do. That early investor hitting $300,000 by 45, they have options. They can slow down, they can shift into dividend income, they can take more risk in their business or career. They've got breathing room. The late investor, still pushing hard, still catching up. Same age, completely different level of pressure. That's the real gap. Let's simplify this. Starting at 25 versus 35 isn't just 10 years. It changes everything that comes after. how much you need to invest, how hard you need to push, how flexible your life becomes later. Numbers don't lie. $500 a month at 25 could lead to around $1 million. $1,000 a month at 35 with the same rate of return could lead to about $830,000. And the early investor contributed less. This isn't about being smarter. It's about starting sooner. If you're already investing even a little, you've done the hardest part. You started. But if you've been waiting to get serious, this is where that decision starts costing real money. Not in theory, in actual dollars. And time doesn't give refunds. So here's the move. Start where you are. Increase what you can. Stay consistent. And if you want to keep tightening your strategy, building real momentum, instead of guessing, subscribe, because the difference between knowing this and actually doing it, that's what changes your outcome. Better investments, better future. Thanks for watching, and I'll see you in my next video.